Hi traders, and welcome to this episode, the 2025 mentorship series. And today I want us to discuss about the ICT mitigation block, right? So when you talk about the ICT mitigation block, of course, that tells you this is not my concept, my original concept. Basically, this concept that is derived to Michael Anderson. So I give all credit to Michael Anderson, but having mentored me, basically I have an understanding of this mitigation block. And what I want to do in this video is to give you a simplified version so that you are able to look at, so that you're able to understand how to trade the mitigation blocks, all right? So, we will begin by understanding what is a mitigation block. So, basically, when you talk about a mitigation block, this is a level or an area where price of the market retraces to, basically to mitigate or to test the imbalance left from previous market inefficiencies. And usually, sometimes in the form of a consolidation or maybe what we call an order block. Okay. So these blocks act as points where institutional players or smart money basically potentially re-enter the market, allowing for higher probability trade setup. All right. So maybe to elaborate it in a simplified version, allow me to draw or to show you in a very simplified manner. So if I push down here, so there are two types of mitigation block. Definitely we have the bearish mitigation block and we have the bullish mitigation block. So the bearish mitigation block usually shows us when the market is gives us the sell entries. So this happens when we have an uptrend. So you see the market creating higher highs and higher lows. All right. So remember the definition that we have given for the mitigation block. This is when the market, a mitigation block is formed when the market, or it's formed when the order block fails to create higher highs. All right. That is in an uptrend market or lower lows in a downtrend market. And the next thing the price does is that it breaks the order block. All right, and the price will get to this broken order block, basically to retest it, to take out liquidity sometimes, and also we see some reversals. All right, so once the price is in this kind of a market structure in an uptrend, but now you see the price failing to do what? Once the price pushes up again, it fails to break above this zone to create another a higher high, and then it breaks below this low point here. All right. So at this particular point where we had this order block that failed to create higher highs, and it gave us what we call a market structure shift. Right, this is what we call a market structure shift. So once that happens, then this is the bearish ICT mitigation block. So the price will come retest there, and then now we see the price push. All right, we see the price push on the upper direction. So let me clarify, or let me show you the difference between a breaker block and a mitigation block, because I know that is the next question that you're gonna ask. So when you're talking about a breaker block, we said that is when the market creates higher highs, or in an uptrend market, creating higher highs, breaking through the order block. All right. So maybe I can illustrate this. So we have this kind of a market structure. So definitely, let me illustrate by the bearish one, so that you can be able to understand. So what we have, so that you can be able to understand, because this is a bearish mitigation block. So for a bearish breaker block, we want to see when the market is doing what? When the market is pushing up, all right? So when the market is pushing down, okay, like that. So then once the market is pushing up like that, it will now, at this particular point, you can see it's creating higher highs and higher lows. All right, so it's creating higher highs and higher lows. So I mean lower lows and lower highs. Those terms definitely tends to really confuse me a lot at some point. Okay, so note how the price is pushing. Okay, note how the price is moving. So we have that. All right. So once we have that, then we know anytime the price retraces to this level, all right, that's where we have a bullish order block. And once the price retraces to this level, what we have here is basically a breaker block, because we anticipated, first of all, we anticipated when the market comes to this level, we want to see the trend continue. All right. So this is an order block. But what we have witnessed now, we see the market breaking above the order block and now coming to retest. So this gives us the bullish breaker block. All right. So for a bearish breaker block, right? For a bearish breaker block, we want to see a scenario where the market is pushing on the upside. So we have this kind of a move, market creating higher highs and higher lows, all right? So we know when the market retraces to this level, maybe at some point here we have an order block and therefore we are looking for buying opportunities. But now we see the market coming, breaking below that, and then coming to retest this level, okay? So this is a breaker block, a bearish breaker block. And you can see now what you are talking about is the difference is that you can see for the breaker block, the market has taken out the liquidities. It has created higher highs. But for the mitigation block, you can see this is the mitigation block. The market has failed here to create a higher high, and therefore it has retraced below this order block. And the moment it breaks below that, we have a breaker block. That is a bearish breaker block. For a bullish breaker block, maybe I can draw it alongside these bullish, I mean, these bullish breaker blocks so that you can understand. All right. So for a bullish mitigation, all right, for a bullish mitigation block, we want to see the price push on the downside, creating lower lows and lower highs. Lower lows and lower highs. So at some point, the market will fail to create a lower low and then break above this, giving us a market structure shift, right? Giving us a market structure shift. So this is where we have now, where we had this order block, that's where now we have the mitigation, bullish mitigation block. We want to see the price retest that zone and then push up, all right? And then push up. So this is a bullish mitigation block. But when you look at the bullish breaker block, you see the price has already created lower lows, all right? The price has already created lower lows. But when it's coming up to retest this order block, since we'll be anticipating sales, it breaks above that point, and therefore we can use this as now a breaker block for a re-entry. So I believe that now clarifies the difference between mitigation block and breaker blocks, right? So let me go into the charts and try to show you some examples in the charts, all right? So when you look at this market, all right, I am using the 15 minutes time frame because in ICT, 15 minutes time frame, myself, I find it being a little bit more ideal because once I have these, the session, the ICT kill zone indicator, therefore I'm able to see the kill zones quite well. You can see this is the Asian kill zone, the dotted one here. This is the green one here, dotted rectangle. This is the London kill zone. Then the purple is the New York kill zone, and then we have the green again here, which is the London close kill zone. All right. So now, remember we said in ICT it's price and time theory. All right, price and time theory. So we see the price creating higher highs and higher lows. But at this particular point, what do we see? This price is unable to create it's unable to break above this high so that we can have a higher high. All right. So what we have there is a market structure shift. Okay. So with that market structure shift, therefore, we can take this, the last buy candle here, being our mitigation block. So we see the price pushing down, then coming back again to retrace, all right? So price coming and breaking through this order block, then pushing up again to mitigate or to test this level. And this is where we have the bearish mitigation block. And this is the point. The moment the price touched here, this is the point that we need to take an entry. And that's how our entry will look like. All right. So see the moment or the time that the price came to this level, it's within the Asian kill zone. So therefore, our entry is valid. All right. Our entry is valid. So we have our stop loss slightly below. Above the mitigation block, and maybe we can eyeball the lows here. All right, so we can eyeball the lows there, and that's a risk to reward ratio of actually about 1 is to almost 1 is to 3 point, almost 1 is to 3.0, right? Almost 1 is to 3.0. So someone might ask me what happens to this level, because if you extend, you find that the price again during the New York kill zone, the price comes again to test the same level where we had the mitigation block. So for me, when I'm trading these blocks, either mitigation blocks, whether breaker block, whether order blocks, I don't trade for the second time. I consider the first mitigation being high probability and the second test not being high probability. Okay, so let's look at some more examples. So here we have some more examples. So when you look at this piece of price action here, the price was pushing on the downside, all right? So when the price was pushing on the downside here, so we see this is the lowest point, all right? This is the lowest point, and then the price created this high point. When the price retraced down here, so it was unable to come to this level to create a lower low so that we can continue the downtrend, all right? So at this particular point, that's now when we see the price pushing on the downside, then failing to create a higher high, all right, a lower low. So this last buy candle here, we can use it as a mitigation block, a bullish mitigation block. Actually, this is a failed bearish engulfing. So a failed bearish engulfing sometimes can give us a mitigation block. So this is where we have the market structure shift. So this is now once the price breaks above, comes to retest, then our setup looks something like this. All right. So that's where our setup needs to be, maybe something like that. All right. So follow me keenly because I'm almost about to draw a trap to you. All right. I'm almost about to draw a trap to you. So we can see that. Okay. So we can say that maybe probably even a risk to reward ratio of 1 is to 3. All right. So that's a good point to take the trade. But I'll tell you that is quite very, very, very wrong. All right, that is very wrong. As much as it might be able to show you that's a mitigation block, but look at this time of the day. All right, so already all the kill zones, it's not within the kill zones. All the kill zones have almost completed. This when the day is almost ending up. So that tells you then this is not an entry as much as it's giving you an illustration that it's a mitigation block, but the time of the day is not the best time to take the trade. So that one, we don't trade that. Even if you trade and you make a profit, that will be mere luck, right? So you have nothing to back. That is basically mere luck. So the key thing is to stick to your plan. Okay. So let's look at another example. So here we have another example. As you can see, the market was pushing up, all right? So creating a higher high. But now, at this particular point, the market failed to create what you're calling what? A higher. It failed to create a higher high. So we consider this level here, all right? We consider that being the breaker block, all right? So we consider that being the breaker block. So this is a bearish what? This is a bearish mitigation block. I mean, so that gives us what we are calling a bearish mitigation block. So, but did the price come to this particular level? As you can see, maybe probably at this particular point you didn't have maybe a retest, right? So we might not say, we can say that maybe probably we didn't have a retest here. So what happens? Sometimes you can be able to go to the lower time frames to see whether the price retested. So maybe if we go to the 5 minutes time frame, let's go to the 5 minutes time frame. This is the 3rd of April. So in the 5 minutes time frame, we try to look at the 3rd of April. So the 3rd of April, the 5 minutes time frame. So this is the third. of April in the 5 minutes time frame. So we are almost there, right? Because sometimes you might not see the retest in higher time frame, but when you go to the lower time frame, you might see the retest, right? So if you look at it in the 5 minutes time frame, actually we don't have a retest because now this will be the breakout. Okay, so for such kind of setup, you just let them go. All right, don't really force yourself into them. So you just let them go, and you are able now to maybe look for another setup, right? So let's look at some more examples. So here we have another best example. So as you can see, this market, the price is pushing up, all right? So as you can see, the price was bullish. Then it created a higher high, all right? So we anticipated the price to continue pushing up. So when the price retraced here, we anticipated this price to continue doing what? Pushing up to create higher highs. More higher highs so that the price can continue pushing up. But you can see now here we have a market structure shift. The price was unable to break above that. So we have a market structure shift. So what we do, we identify the last candle there, right? So that's being our bearish mitigation block. And you can see when the price came to retest that, it is during the London kill zone, right? During the London kill zone, that's when the price came to retest that. And therefore, we have our very nice short entry. All right, so we have our stop loss above the mitigation block, and maybe we can eyeball these lows here. All right, we can look at the price coming to take out even the London, I mean the New York lows. All right, maybe you're targeting this New York session low of yesterday or the previous day here, and as you can see, the price came very well. A risk to reward ratio of about 3 is to almost 3 is to 4 or 1 is to 4, and that was quite a nice entry. Okay, that was quite a nice entry, about 191 pips. Okay, so let's look at the last example for a bullish mitigation block. Here is a nice example of a bullish mitigation block. As you can see, this price was in a downtrend, creating lower lows and lower highs. You can see that it was in a downtrend, creating lower lows and lower highs. So this was the last lower low that the price created at that particular point, and then it pushed up to about almost this high. Okay, so when the price retraced back, it was unable to break below this low so that it can continue forming a lower low. So here we have a shift in market structure, right? We have a shift in market structure. And then now we use the last, this last candle here, all right? We use that, the last candle that we have around that particular point, okay? So that one. So and actually we are using this buy candle. It's the one that you look at the candle that created the top, the high. So if we look at the price of this candle is 744.96. This other one is 74.84. So this is the highest. So we are going to use that. All right. So then we have what? The price come break above, so and then we have an immediate retest. You see here, so we are marking from week to week or from week to the last to week. So this is the candle. So this is the candle. Look keenly. This is the candle here. So then we have the breakout. Then we have this candle to come and retest. So when was the candle retesting here? So it is during the New York kill zone, right? It is during the New York kill zone. If you're not sure about maybe that kind of a retest, if you push up above again, if you extend, maybe if you are not sure whether this is a retest, because again, depending on the broker, it might bring some contradiction. So if you didn't maybe probably take a sell, if you didn't see clearly from your broker, maybe this is a retest, right? So that maybe you can take a buy there. And when you take a buy there, you are eyeballing these, maybe probably these highs here, okay? So you are eyeballing those highs there. So what is of importance is now Once the price gives you a half of your target, this is a risk to reward ratio of about 1:5. And you can see the price went far away above the half of that target, 2.1 is to 2.5. So a half of that you take partials and you put your stop loss at your entry or at break even. But again, if you didn't see that, maybe probably it was not precise. Again, don't force if it's not precise. So come here during the London, during the all right, during this particular point, okay, during this particular level. So is this a valid entry? All right, is this a valid entry? Someone may say yes, someone else may say no. But what we have here, this is not a valid entry. As much as it has come to retest here again for maybe the second time, this is not this is not a good entry. Why? Because of the time aspect. You see, when the price is coming to this zone or to retest this zone, this is not the new, it's not a kill zone. It's not within the kill zone because the last kill zone is this one here, the London close kill zone. All right. So if you didn't see this, then maybe, or if you didn't go to the lower, because if you went to the lower time frame, because sometimes it can break out immediately, like we have here, break out immediately and retest immediately. All right. So sometimes it can do that. So this is where the entry was. If you didn't see it, it was not clear to you, then leave it and wait for a proper one that will form, because they will definitely form. All right. So ladies and gentlemen, one thing that you need to understand is that these strategies, especially if you are trading only one instrument, they will not happen all the time. All right. They will not happen all the time. So if they will not happen all the time, then what do you need to do? So the reason why you find that maybe on a weekly time frame, you might get 2 to 3 setups. Maybe if you are lucky enough, you can get 4 setups, but 2 to 3 setups on a weekly basis, then you'll find that strategy working out. All right, maybe 2 to 3 setups on a weekly basis. If you're trading only one pair all through. But if you're trading different pairs, if you don't find that strategy functioning all happening, maybe probably in gold, if you trade gold, you can switch to Euro USD or maybe GBP USD or any other asset. That is if you're trading maybe 2 to 3 pairs. You trade 2 to 3 pairs. So if you don't find it in one pair, you can look it in another pair. All right. So that's it. If you have any queries, make sure to put them on the comments. I'll be able to answer. And also maybe some of the concept that you might want me to be able to look at, you can put them in the comment section and I'll be able to create videos that will be very much beneficial to you in terms of understanding the concept that you look to understand. So the key thing lies to you now as a trader. Once you learn, go back test, try to learn more, do some more back testing and try to validate that strategy in your demonstration account before you start trading live. All right. So thank you so much. And until then, see you in the next webinar.